The story of WeWork is a tale of ambition, excess, and ultimately, a spectacular fall from grace. Founded in 2010 amidst the aftermath of the financial crisis, WeWork tapped into the burgeoning gig economy and the growing desire for flexible workspaces. What began as a simple idea, renting out desks in a shared office environment, quickly morphed into a global phenomenon. Fueled by charismatic leadership and a compelling narrative of community and innovation, WeWork attracted billions in venture capital. The company expanded at a breakneck pace, gobbling up office space in major cities worldwide. WeWork's valuation soared, reaching a dizzying $47 billion at its peak. The company's success seemed unstoppable. WeWork wasn't just selling desks, it was selling a lifestyle, a sense of belonging, and access to a vibrant community of like-minded individuals. WeWork's rise mirrored the broader cultural shift towards entrepreneurship, remote work, and the blurring of lines between work and life. At the heart of WeWork's meteoric rise was its innovative business model. The company leased large office spaces, often at premium rates, and transformed them into stylish, amenity-rich co-working spaces. These spaces were then rented out to individuals and small businesses seeking flexible and affordable office solutions. While seemingly straightforward, WeWork's model was built on a precarious foundation. The company relied heavily on long-term leases while generating revenue from short-term memberships. This mismatch created a fundamental vulnerability. WeWork was exposed to significant financial risk in the event of an economic downturn, or a decline in demand for co-working space. Furthermore, WeWork's rapid expansion came at a cost. The company poured vast sums of money into acquiring real estate and outfitting its spaces with luxurious amenities. This aggressive spending, coupled with generous discounts and promotions to attract new members, raised concerns about WeWork's path to profitability. As WeWork's valuation soared, so too did scrutiny of its eccentric and controversial CEO, Adam Neumann. Neumann, known for his charismatic personality and unconventional leadership style, became synonymous with WeWork's culture of excess. However, behind the carefully crafted image of a visionary entrepreneur lay a darker side. Allegations of workplace misconduct, self-dealing, and financial impropriety began to surface. Neumann faced criticism for his lavish lifestyle, his conflicts of interest, and his questionable business decisions. Lawsuits were filed, and the company's reputation took a hit. In 2019, under mounting pressure from investors and the board of directors, Neumann was forced to step down as CEO. His departure marked a turning point for WeWork, signaling the end of an era and the beginning of a long and painful reckoning. The cracks in WeWork's facade became impossible to ignore when the company filed for an initial public offering in 2019. The IPO prospectus, which revealed the full extent of WeWork's losses and corporate governance issues, sent shockwaves through the financial world. Investors, once enamored by WeWork's growth story, began to question the company's sky-high valuation and its path to profitability. The IPO was ultimately pulled, dealing a significant blow to WeWork's credibility and leaving the company in a precarious financial position. The failed IPO marked a turning point in WeWork's trajectory. The company's narrative of innovation and disruption unraveled, revealing a business model built on shaky foundations and questionable financial practices. Just as WeWork was grappling with the fallout from its failed IPO, the COVID-19 pandemic struck, delivering a crushing blow to the company's already fragile business. Lockdowns and social distancing measures forced businesses to embrace remote work, decimating demand for office space. WeWork, with its vast portfolio of long-term leases and reliance on short-term memberships, was ill-equipped to weather the storm. Occupancy rates plummeted, revenue dried up, and the company's losses mounted. The pandemic exposed the inherent vulnerabilities of WeWork's business model and accelerated its descent into financial distress. In the wake of financial turmoil, WeWork embarked on a journey of restructuring. This process was aimed at eliminating its overwhelming debt, and it marked the dawn of a new beginning for the company. By shedding non-core assets and refocusing on its core business, WeWork sought to stabilize and rebuild. It was a challenging yet necessary step to ensure the company's survival and future growth. The dramatic plunge in WeWork's valuation was a wake-up call for investors and the business world alike. Initially valued at $47 billion, the company saw its worth plummet to a fraction of that amount. This stark decline was due to a combination of overambitious expansion, unsustainable business practices, and a lack of effective leadership. It served as a reminder of the volatility and risks inherent in high-growth startups. From the rise and fall of WeWork, several important lessons emerged. Companies must prioritize sustainable growth over rapid expansion. Transparency and accountability in leadership are crucial to maintaining investor trust. Additionally, the importance of a viable business model cannot be overstated. As WeWork moves forward, these lessons will guide its path, helping to build a more resilient and focused organization. Despite WeWork's tumultuous journey, the appeal of shared workspaces remains strong. In a post-WeWork world, the demand for flexible, collaborative working environments continues to grow. Businesses and freelancers alike appreciate the benefits of cost savings, networking opportunities, and the dynamic atmosphere that shared workspaces provide. The concept has proven to be more than a fad, evolving into a staple of modern